Welcome to the research desk.
Hey.
So, imagine building like a mathematical machine that's so conceptually flawless that it perfectly maps every single nuance of the market's historical behavior. It spots hidden patterns, it uncovers these invisible correlations, and it just prints this pristine, upward-sloping equity curve right on your monitor.
Oh, the dream. The absolute dream.
Right? But then, you plug it into a live exchange with real capital, and within a week, it loses millions of dollars.
Yeah. A tale as old as time.
Exactly. So today, we are investigating a phenomenon that sits at the exact intersection of computational science and financial theory. We are analyzing the deployment of machine learning across quantitative finance. And the central question we're debating today is this: is machine learning the next durable source of investment edge, or is it merely the most sophisticated way finance has ever found to fool itself?
That's the billion-dollar question.
Literally. So my position is that machine learning provides a genuine structural edge in nonlinear finance. It achieves this specifically by capturing complex market interactions and fusing heterogeneous data sources that, honestly, traditional econometric models simply cannot process. The financial markets are fundamentally nonlinear, and machine learning architectures are uniquely built to map that exact reality.
Well, in my position is that machine learning in finance is fundamentally the greatest backtest in history. The financial market is it's an adversarial system operating in a stubbornly low signal-to-noise environment. It is an environment perfectly calibrated for false discovery. When you deploy highly parameterized models into regimes characterized by really small effective sample sizes and non-stationary behaviors, you are not capturing a durable edge. You are merely fitting noise to an exquisite degree of precision. You're basically building a machine that memorizes the past, but is structurally blind to the future.
Okay, well, let's begin by examining the core mechanics of why machine learning represents, in my view, a genuine evolutionary leap in financial modeling. The traditional quantitative approach relies really heavily on linear regressions and, these rigid assumptions about normal distributions. Traditional finance basically assumes that if variable A increases by 1 unit, variable B will respond in a proportionate, predictable manner.
Right, the old straight line assumption.
Exactly. But finance is not linear. Economic variables interact in highly dynamic, conditional ways. So tree-based methods, like random forests and gradient boosting machines, alongside deep neural networks, they structurally align with the complex reality of the markets. They don't force data into a straight line. And look, the empirical evidence we've analyzed is compelling. When machine learning is applied to stock forecasting accuracy, we see documented gains of 8 to 12% over baseline models.
Sure, on paper.
Well, hold on. When applied to earnings forecasts, machine learning models demonstrate greater than a 10% improvement over traditional consensus estimates. Furthermore, if you utilize machine learning for beta estimation, it yields Sharpe ratios that are 3 to 6% higher. The mechanism driving this edge is data fusion.
Data fusion.
Yes. Machine learning uniquely possesses the dimensional capacity to combine fundamental accounting data, macroeconomic indicators, technical pricing signals, consumer sentiment metrics, textual analysis from earnings calls, and alternative datasets like satellite imagery into a single cohesive predictive framework. Traditional models collapse under that dimensionality, but machine learning, it thrives on it.
Okay, but the metrics you cite are impressive in a vacuum. I mean, an 8 to 12% improvement in forecasting accuracy sounds like a revolution.
It is.
But the financial market is the ideal environment for generating spectacular numbers that ultimately mean absolutely nothing in practice. The core issue here is overfitting, which stems directly from the fact that we are operating in a domain characterized by remarkably small effective sample sizes.
Wait, small? We have petabytes of tick data.
You may have millions of tick-level price updates on a given trading day, sure, but you only have a handful of distinct macroeconomic cycles. You have exactly one Volcker inflation era. You have exactly one global financial crisis.
Okay, that's fair.
Right. As researchers like Arnott, Harvey, and Markowitz have extensively warned, The vast majority of backtested strategies ultimately fail when exposed to live capital. Statistical improvement does not equate to economic improvement. Achieving a better root mean square error, which, simply means your model's predictions mathematically sit closer to historical prices in a laboratory setting, is entirely meaningless if the turnover required to capture that signal destroys your capital.
Well, obviously you have to account for friction.
But they often don't. If your algorithm trades 1,000 times a day to capture micro inefficiencies, the associated transaction costs, the bid-ask spread, and crucially, the market impact of your own trades will completely destroy the P&L. A machine learning model deployed without robust, theoretically grounded economic restrictions is simply a machine for compressing noise into a compelling narrative. It finds patterns where none exists, capitalizing on the illusion of certainty.
Okay, I agree that skepticism regarding statistical precision versus economic reality is necessary. But the base rate of failure in poorly constructed, naive models does not invalidate the underlying mathematical architecture.
I come at it from a different way. We cannot discuss empirical reality without establishing the actual base rate of algorithmic failure. Consider the rigorous test conducted by Thomas Viecki. He evaluated 888 algorithmic trading strategies.
Ah, the wiki study.
Yes. And these were not amateurish, poorly constructed models. They were sophisticated mathematical constructs deployed by quantitative researchers. But when these models were subjected to out-of-sample testing, meaning they were exposed to data they had absolutely no access to during their training phase, the results were catastrophic.
They didn't all fail.
The vast majority of those 888 strategies completely failed, they collapsed. This establishes the true base rate of algorithmic trading. The default state of a machine learning model in finance is failure.
That's a strong statement.
But it's true. The algorithms perfectly memorize the training data, optimizing every parameter to explain past anomalies, and entirely failed to predict the future. This happens because the models are wildly over-parameterized. They capture transient historical correlations like, a brief relationship between copper prices and tech equities in a specific quarter that have absolutely no structural permanence. When the future arrives, those spurious correlations dissolve and the strategy hemorrhages capital.
I see why you think that, but let me give you a different perspective. The failure of Wiki's 888 strategies highlights the exact inadequacy of applying linear expectations to nonlinear data. Traditional linear models fail specifically because they misunderstand the fundamental shape of the market.
Explain what you mean by the shape of the market.
So to understand how markets actually function, consider the narrative structure of a Christopher Nolan film.
Oh, I like this. Okay.
Right? Markets do not behave like straightforward linear detective novels where clue A leads directly to conclusion B. Instead, they behave like Nolan timelines. They're characterized by looping sequences, hidden dimensions, and nonlinear interactions. An interest rate hike does not impact the market in isolation.
True.
Its impact is conditionally dependent on consumer sentiment, prevailing volatility, and supply chain bottlenecks, all feeding back into each other simultaneously. A linear regression looks at a complex Nolan timeline and attempts to force it into a straight, predictable line, losing all the critical information embedded in those conditional loops. Machine learning algorithms, precisely because they can model high-dimensional feature interactions, correctly map this complexity.
On past data.
They mathematically understand that the relationship between two variables might entirely reverse depending on the state of a third variable. The failure of those 888 models was a failure of unconstrained architecture, not a failure of the nonlinear premise itself.
Understanding complexity is fundamentally different from monetizing it. Let's move from theoretical timeline mapping to the highly unforgiving practical reality of live markets. We have a perfect narrative demonstrating this exact failure of complexity.
Let me guess, the 25% backtest?
Exactly. There was a quantitative fund that launched a highly sophisticated machine learning strategy boasting extraordinary metrics. They presented a 25% annualized return in their backtest and a Sharpe ratio soaring above 2.5.
Which is absurd.
Right. In the world of quantitative finance, a Sharpe ratio of 2.5 is considered the holy grail. It suggests near perfect risk-adjusted returns with virtually no volatility. It basically implies you have discovered a money printing press.
Yeah, it's the kind of number that makes allocators salivate.
Oh, absolutely. Yet what was the detailed postmortem when this exact model was deployed with live capital? The live performance completely flattened. The pristine equity curve generated in the laboratory just vanished, and the strategy quickly suffered drawdowns exceeding 15%. The postmortem revealed exactly what went wrong. The failure was driven by extensive data snooping and highly unstable features. The machine learning model had identified hyper-specific, nonlinear interactions in the historical data that were entirely spurious. It optimized itself perfectly for a market environment that had already ceased to exist. The algorithm essentially mistook a random walk for a structural law.
Okay, but the failure of an unconstrained model operating without risk parameters is a lesson in implementation discipline, not an indictment of the technology itself. To counter your example of failure, let us examine where machine learning succeeds precisely because traditional valuation models structurally break down.
All right, I'm listening.
Consider the surge in Tesla's equity valuation during early 2020.
Oh, man, yeah.
Traditional quantitative models, relying on discounted cash flows, price-to-earnings ratios, and standard momentum factors, they completely struggled to process the price action. By classical metrics, the asset was uninvestable. The numbers defied traditional economic gravity.
It was completely detached from fundamentals.
Exactly. However, machine learning-driven systems that systematically incorporated natural language processing and social sentiment analysis successfully captured the momentum. These algorithms fused unstructured data from social media chatter, retail options flow, and narrative momentum into their predictive frameworks. They recognized a regime shift that the traditional models were structurally blind to. The Tesla surge wasn't a failure of valuation. It was a transition into a new dynamic, where retail sentiment and option dealer hedging dictated capital flows far more heavily than corporate fundamentals. Machine learning identified the new dominant feature and adapted, capturing substantial economic gains while linear models were left, basically attempting to short a runaway train.
Look, capturing the Tesla momentum through sentiment analysis is an impressive anecdote. But we must rigorously evaluate whether this is a replicable, systematic edge or simply an instance of survivor bias in a low signal-to-noise environment.
It's a clear signal.
A model that happens to correctly weight social sentiment during a retail-driven stimulus bubble looks like absolute genius in hindsight. The real question is operational durability. I'm sorry, but I just don't buy that. Let me tell you why. The operational realities of deploying machine learning at scale introduce severe bottlenecks that frequently erase any theoretical alpha. Consider the documented story of a fund that spent $50 million specifically on pure machine learning infrastructure.
$50 million.
$50 million? We're talking about massive data pipelines, cutting-edge computing clusters, and the procurement of highly esoteric alternative data sets. All of this capital expenditure was designed to achieve a modest 7% improvement in forecasting accuracy. And what was the outcome?
The crucial failure point was not the mathematics, it was the plumbing.
The plumbing?
Yes, data synchronization delays and immense ongoing maintenance costs completely blunted the actual economic gains. When you are processing heterogeneous data sets, aligning the exact timestamp of a satellite image with the microsecond tick-level price of a commodity contract introduces latency, look-ahead bias, and execution errors. Furthermore, these models possess immense regime fragility. Look at the hedge fund that lost 20% in just 2 months during the onset of the COVID pandemic.
Well, everyone struggled during COVID, sure. But consider the fund that suffered a 15% drawdown during the 2018 United States-China trade conflict, or how commodity models entirely failed when the Organization of the Petroleum Exporting Countries fundamentally altered its supply behavior.
These algorithms broke because they were trained on historical data regimes that did not include global pandemics, unprecedented tariff wars, or sovereign cartel behavioral shifts. The models were mathematically elegant but operationally fragile, brittle, and impossibly burdensome to maintain.
That's an interesting point, though I would frame it differently. I will concede that deploying unconstrained end-to-end machine learning systems to directly trade markets, handing a neural network a petabyte of raw data and asking it to find alpha without economic supervision is an exercise in operational fragility. It will fail.
Thank you.
However, the true edge lies in utilizing machine learning for the better estimation of familiar, established financial objects. We must examine the work of Pedersen, Babu, and Levine regarding enhanced portfolio optimization.
Right. EPO.
Exactly. Instead of asking a machine to predict the future price of a stock, which is notoriously difficult, you apply machine learning techniques to traditional portfolio theory. Specifically, you apply ridge regression. Markowitz portfolio optimization traditionally breaks down because estimating the covariance matrix, which measures exactly how every single asset moves in relation to every other asset, is highly prone to error. If you have 500 stocks, you must estimate over 120,000 distinct relationships.
Which is just a statistical nightmare.
It is. Traditional statistics fill that matrix with noise, and the optimizer maximizes that noise, resulting in extreme, unstable portfolios. But by applying the penalty functions inherent in ridge regression, we systematically shrink the noisy, off-diagonal elements of the covariance matrix. We mathematically force the spurious correlations toward zero. We stabilize the portfolio. We are not discarding traditional finance. We are using advanced computational techniques to repair its structural weaknesses. This solves the operational fragility you describe. The machine is constrained by the strict mathematical logic of portfolio theory, merely acting as a superior estimator of underlying risk and correlation.
Okay, let us assume you successfully solve the covariance estimation problem using ridge regression. Let us assume your risk models are perfectly calibrated. You still face the ultimate inescapable bottleneck of any successful strategy. You face the physical limits of market microstructure. We must address the issue of capacity.
Aha, capacity. Let us address capacity directly. The absolute benchmark for quantitative success is Renaissance Technologies' Medallion Fund. We are looking at a fund that generated roughly 40% or more in annualized net returns over several decades.
Unbelievable numbers.
Unparalleled track record in the history of modern finance. And the definitive lesson to extract from Medallion is the triumph of an industrial research process. It's not about a replacement ideology where autonomous machines unilaterally replace human intelligence. It is about a relentless, highly disciplined, systematic process of hypothesis generation, feature engineering, and rigorous scientific testing. They built an architecture capable of processing vast amounts of information, identifying minute statistical anomalies, and continuously updating their models in response to new data. They proved that a structural edge can exist and persist over decades.
Look, I agree completely regarding the brilliance of Medallion, but your interpretation entirely misses their fundamental operational lesson. Medallion's extraordinary returns did not lead them to unlimited asset gathering. They notoriously capped the size of the fund at roughly $10 billion, forcibly returning capital to their employees year after year.
Right, because they knew their limits.
Exactly. The smartest quantitative shop in the history of finance treated capacity, not intelligence, as the absolutely scarce resource. This exposes the fatal flaw in how machine learning is frequently marketed and deployed today. Many contemporary machine learning systems are hyper-optimized for prediction metrics. They maximize accuracy on a theoretical validation set. But a prediction metric is not deployable alpha.
Well, it has to be translated into execution.
And that execution must survive the friction of the market. We must examine this through the lens of hydrology. A model's theoretical alpha cannot exceed the economic reality of the market, precisely in the same way a river cannot exceed its watershed capacity without flooding and dissipating. If a machine learning strategy identifies a complex, nonlinear inefficiency in a microcap equity or an obscure derivative market, the moment you attempt to deploy significant institutional capital to exploit that inefficiency, your own trading behavior fundamentally alters the price.
You impact the market.
You become the marginal buyer. You push the price against yourself. The watershed is strictly limited. The inefficiency is instantly arbitraged away by your own execution. Capacity is exactly where elegant, highly predictive machine learning strategies go to die. They look brilliant on paper, but the market structure simply cannot absorb the capital required to make the computational complexity worthwhile.
Well, the constraints of capacity and market friction are precisely why the industry is evolving away from simplistic, isolated models and moving toward integrated architectures. Both of our perspectives naturally converge on the idea that the contest was never truly machine learning versus traditional quantitative finance. The real battle is research discipline versus seductive computational complexity. The solution to both the capacity limits and the operational fragility is the hybrid approach.
Okay, a hybrid approach. Tell me more.
The evidence provides a clear narrative documenting the success of hybrid systems actively outperforming their peers. A major quantitative firm developed a hybrid model that systematically combined classical, academically proven factors such as value, momentum, and quality with a deep neural network analyzing macroeconomic conditions and alternative data.
Fusing the old and the new.
Right. This hybrid system successfully outperformed both pure machine learning models and pure traditional quantitative models by 2 to 3% annualized over a rigorous 24-month period. This proves that architecture beats ideology.
I can actually get behind that. Let us rigorously outline exactly why this hybrid approach functions mathematically. It works because it fundamentally respects boundaries. Traditional quantitative finance provides the necessary priors, the strict constraints, and the vital interpretability. Machine learning, acting strictly within those defined boundaries, provides the nonlinear mapping, the complex feature extraction, and the adaptive blending of different signals.
Exactly. It's guided discovery.
Consider an unconstrained neural network. It might analyze a spurious correlation in the data and suggest taking a massively leveraged, highly concentrated position in a single obscure asset. The traditional quantitative overlay immediately vetoes that action. It enforces diversification rules, liquidity constraints, and maximum exposure limits. Economic restriction is the absolute non-negotiable precondition for intelligence in finance. Without the guardrails of economic theory, the algorithm is blindly navigating a chaotic adversarial system, basically optimizing for disasters.
That dynamic interaction perfectly aligns with the mechanics of jazz improvisation.
Jazz? Okay, lay it on me.
Think of traditional financial logic, the economic framework, the risk parameters, the portfolio constraints. Think of all that as the underlying chord progression in a piece of music. The chord progression provides structure, predictability, and a foundation. Good machine learning operates like a highly skilled jazz musician improvising over those exact chords.
Oh, I see where you're going.
The algorithm continuously updates, it adjusts its statistical riffs, and adapts its models in real time to capture new patterns and fleeting opportunities in the data stream. But it never abandons the underlying chord progression. It explores the nonlinear space within a highly structured reality. This adaptive retraining is what allows the model to capture that 2 to 3% excess return without descending into chaotic, unmanageable risk. It navigates the timeline loops we discussed earlier, but it does so while heavily tethered to fundamental economic gravity.
That is a very compelling analogy. But we must now translate these theoretical architectures, these hybrid structures and jazz analogies, into practical, rigorous implications for capital allocation. Because there are strict, mathematically driven rules for deploying capital in this space based on the material we've reviewed.
Absolutely. The numbers dictate very specific target allocations for institutional portfolios evaluating quantitative strategies. The evidence supports overweighting hybrid quantitative managers by 5 to 7%.
And these are the specific managers demonstrating the structural discipline to blend established economic theory with advanced computational power.
Right. Conversely, the rules demand underweighting pure-play artificial intelligence quantitative funds, those lacking strict implementation discipline and relying entirely on end-to-end black box predictive systems by exactly 10%.
A massive underweight.
Exactly. Furthermore, regardless of which specific algorithm ultimately wins the alpha generation race, the underlying demand for data processing will inevitably expand. Therefore, the strategy suggests overweighting the underlying data and compute infrastructure providers by 7%, recognizing that the plumbing of the system is ultimately the most durable asset.
Allocating that capital requires draconian due diligence, though. The absolute priority is demanding out-of-sample proof across multiple distinct market regimes. A backtest running exclusively through a decade of quantitative easing where asset prices were unilaterally supported by central banks, is entirely invalid.
It's basically fantasy.
Yes. We must enforce a strict deviation rule for live deployment. If the live performance of a machine learning model deviates from its historical backtest metrics by a 15% threshold, the capital allocation must be immediately cut by half. There is absolutely no room for waiting to see if the model eventually recalibrates.
A 15% deviation indicates a structural break.
Precisely. It indicates a break between the model's fundamental assumptions and the current market reality. The regime has shifted, and the model is now actively destroying wealth. Additionally, capacity must be utilized as a hard, non-negotiable due diligence filter. If a portfolio manager cannot precisely articulate the total deployable capacity of their strategy, including exact mathematical estimates of market impact and execution slippage, they do not understand the watershed limit of their own alpha. They are selling a theoretical simulation, not a viable financial product.
I completely agree. And from a geographical and data quality perspective, there is a clear preference for allocating capital to United States and European hybrid strategies. These specific markets provide the deep, structurally sound, highly standardized, and heavily audited datasets required to train robust machine learning models.
Yeah, the data environment matters immensely.
We must actively avoid weaker data environments and emerging markets where the machine learning algorithms would simply be amplifying underlying data reporting errors and liquidity gaps. So, to summarize the breadth of our analysis today, machine learning's strongest and most durable edge appears specifically in narrow, defined tasks. It excels at complex forecasting, dynamic risk estimation, and processing massive alternative datasets for feature extraction. Its mathematical power is genuinely unlocked only when it is structurally fused with traditional economic logic and portfolio theory.
And my summary remains focused on the absolute necessity of skepticism and limitation. Without relentless out-of-sample validation, without draconian capacity constraints, and without rigid economic boundaries, machine learning is just a high-tech noise compressor. It will reliably identify complex patterns that do not exist in reality, and it will lose capital with unprecedented efficiency.
Fair enough.
But both of us, despite our distinctly different entry points, fundamentally agree that the true realization in modern quantitative finance is recognizing exactly where in the investment stack machine learning actually belongs. It is a highly specialized tool for specific tasks, but it is definitively not an unconstrained end-to-end black box capable of replacing foundational economic rationale.
Machine learning is real alpha infrastructure.
Not magic alpha by itself. This is the research desk officially signing off.